Investing section. From a financial standpoint, an investment is a commitment of present dollars with the expectation of a profit in the future. The advantages of real estate are appreciation, which is the increase in property value over time; cash flow from an item such as an income property; leverage, which is the ability to use other people's money to purchase property; equity buildup, which is taking the current value of the property and subtracting all liens against it. Remember, a lien is money you owe, so equity would be all the money you can take home when a property is sold after you pay off all your debts. Here are some of the big disadvantages of real estate. It takes a huge knowledge base to be successful. It is not a game for the novice. It is not very liquid, meaning it is not easily converted to cash, whereas other investments, such as stocks, can be converted to cash quickly. This is why real estate is a long-term investment and why you want to leverage other people's money. Your money is not easily accessible if you put it into real estate, hence not very liquid. Real estate may not be as big of a risk as many other businesses, but there is still an inherent risk, as things can happen to the property or the market that you cannot control. Let's review some other terms that come up when investing in real estate. Pyramiding is the process of borrowing against one property to invest in another. Arbitrage is when you borrow money at one interest rate and lend it at a higher interest rate. Syndication is a pooling of money for investment purposes. Syndications may be formed as common ownership, joint ownership, corporations, and partnerships. A security is the joining with others for investment purposes. Profit is to be made from the efforts of others. Stocks and bonds are examples of securities. Usually, somebody selling a security must be licensed. A partnership is an association of two or more people as co-owners. A partnership can hold title to real estate. If the proper documents are filed, the partnership does not need to pay taxes, but each individual must pay taxes on the money distributed to him or her. In a general partnership, all partners must participate in management and are personally liable for all partnership activities. In a limited partnership, there is at least one general partner and the others are silent partners. In a limited partnership, the individuals are only liable to the degree of their investment and have no say in management. A joint venture is the joining of two or more people in a business transaction. Joint ventures are characterized by their time limitation. Usually when people create a joint venture, there is no intention by the parties to enter into a continuing relationship. In a real estate investment trust, there must be at least 100 investors who pool their money together and participate in large real estate projects. The investors are beneficiaries who transfer title to a trustee who manages the properties for them. A real estate investment trust avoids double taxation and allows a pass-through of income if certain criteria are met. If at least 75% of the trust assets are in real estate, and if the trust passes 95% or more of their annual income to the investors, the trust is exempt from paying corporate tax. The investors receive certificates of ownership as evidence of their investment. These certificates or shares are freely transferable. A corporation is a legal entity created under state law. The law views a corporation as an artificial person. A corporation is characterized by its perpetual existence, meaning a corporation cannot die, but it can be legally dissolved. The advantages of a corporation are: it is a legal person created by law, and it will continue after the death of even its officers. The stockholders can only lose the amount they invested, and investors can freely transfer their shares of stock. The disadvantage of a corporation is that if a corporation makes a profit, the corporation must pay taxes, and the investors must pay taxes on the profit distributed to them. Thus, there is double taxation. Should the corporation suffer a loss, it cannot pass the loss into the shareholders. This concludes the section on investing.